Buddy, welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner, and today we're going to go over my weekly Bitcoin fundamentals report. You guys can sign up for that free over on bitcoinandmarkets.com. So we're going to go through headlines, price, mining, and lightning news. It's kind of a broad update on the Bitcoin market. So that's what we have on the agenda for today. Happy Monday, day after Easter. Hope you guys had a good Easter. Back to the grind. Once again, back to the grind on Monday. So, all right, let's share the screen and get into it. This is the website where you guys can sign up for that free newsletter. Today's issue is 236. And I always start out with a Bitcoin meme. It's getting harder and harder, especially in these kind of down times where Bitcoin is a little bit more boring, that to find a meme every single week, but I'd like a good one. But anyway, this was my Easter meme for this week. And I always start off each newsletter with a snapshot of Bitcoin. So the weekly trend is intense flatness, at least until I hit publish on this post, because we have had a spike in the price just in the last about hour, and I will go over that here in a second. The media sentiment is negative, but it's less negative, I think, right now than it has been in the last few weeks, just mainly because of the boring nature of the market right now. There seems to be a lot of systemic things going on with de-dollarization, with just political back and forth, that Bitcoin seems to be taking somewhat of a back seat in the media. Right now, it's not getting nearly as much media's attention as it did just a couple weeks ago. And so that has gone from very negative on the snapshot here to just negative media sentiment. We did have that New York Times article, which I wrote about down below here. We'll go over that in a second as well. Okay, network traffic is moderate, and we will cover the mempool stuff here in a second. The mining industry is steady. The price did go up about 2% since the last report. We're over the $500 billion mark for market cap, so I think that's an important level as well. Well, the $1 trillion level will be very important, but you guys know me. One of the things I talk about is Bitcoin can't change the world until it has a very high market cap. So if you're a Bitcoiner and you want Bitcoin to change the world, it can't stay stagnant. It will not change the world if it stays stagnant. It actually will offer a counter, it'll offer a narrative weapon by the establishment, by the status, by the corrupt authoritarians. A stagnant Bitcoin offers them an example to say, look, libertarianism doesn't work, freedom doesn't work, private money doesn't work, or else Bitcoin would be much higher. So Bitcoin has to go up for Bitcoin to fix the world, at least have a positive impact on the world. And by nature, if Bitcoin's market cap is going up, the price of Bitcoin is going up. Higher prices fix everything. Price really is the only thing that matters, and that's one of the things I talk about incessantly on this show. Price tells you everything you need to know about what's going on in Bitcoin. Okay, Satoshi is about 3,500 Satoshis per dollar. That's looking good. And one Finny, which is 10,000 sats, or 1/10,000th of a Bitcoin, is $2.85. The mining difficulty did adjust just a couple days ago, up 2.2%. It's estimated to be negative slightly in 10 days from now, but of course, anything can happen with the price pumping right now. We might see a surge as well in hash rate to follow. Okay, mempool is under 100 megabytes. We'll take a look at how exactly that's broken down. Fee to get into the next block is 64 cents roughly, 52 cents for a median fee. Not that bad at all. I mean, you can't make microtransactions like you can on a Lightning Network, but you can send a $10 payment for, 60 cents to get in the next block. That's a pretty fair fee at this point, I think. Okay. Lightning Network, the capacity did go up about 0.5%, 5,467 Bitcoins. The channels, however, decreased slightly by 27 channels. And all of these numbers are since the last issue, since last Monday. Okay, in case you missed it, I have this section of all the stuff I put out last week. I'm still working, trying to catch up on these live streams, getting them out in podcast. That's the story of my existence at this point. But we did have a FedWatch last Thursday, which we went over a lot of economic numbers. We have a big week in economic numbers this week with CPI coming out. So stay tuned for that. Okay, headlines. Another intensely quiet week for Bitcoin and the global economy as a whole. The global themes this week were zero price action, more attacks on dollarization and Bitcoin, and cracks appearing among globalist elites. Top headline story is the real world costs of the digital race for Bitcoin. This was this hit piece out of the New York Times when they tried to crap all over Bitcoin mining. Right off of the get-go, it was a horrible article. Pierre Rochard pointed out that the caption for the top image had the city misspelled. They had Rockland, I think, instead of Rockdale, Texas. Also, this image you can kind of see on the screen here. If you guys are watching on YouTube, Twitter, Twitch, I'm also going on this new platform. I think it's called Vita that I was on with the Orange Pill podcast. So if you're watching on any of these things, you can see the picture on the left is hazy. And that was in the New York Times, when the picture on the right is crystal clear. There's no problem with the air quality in Texas. They're just trying to paint the picture, of this being hazy there because of the dirty Bitcoin mining industry. But that doesn't speak very well for this article. Right off the bat, it has two false claims here. A bunch of other real journalists immediately jumped on, pointing out the false data that they had. So they had a big table of a bunch of Bitcoin miners and how much fossil fuels they rely on, in their energy mix. And I think his last name is Batten on Twitter. I've talked about him, I think last week or 2 weeks ago here on the show. He's done a study on the Bitcoin energy mix, or the Bitcoin mining energy mix. And he said that those numbers are just completely wrong. So are you going to believe somebody that did an in-depth investigative journalism piece? Or are you going to believe the New York Times that right in the very first image and caption, they have faulty journalism? That's the decision you have to make. Okay, next story here is Texas would create state-issued gold-backed currency. Talked about this on the Telegram server. I mean, this article just shows how naive even people in the gold bug space, because this is from Shift Gold, even people in the gold bug space are incredibly ignorant about the recent history of money. They probably can tell you how many grains of silver constituted $1 in the year 1842. All right. But they can't tell you that there was a gold-backed digital currency in the 1990s. So it's just stunningly naive and ignorant about this stuff. So they say a gold-backed digital currency would create an alternative and allow individuals and businesses to avoid a CBDC. I mean, Texas doesn't have to do this. There are many gold-backed currencies already out. The famous one from several decades ago was Liberty Reserve. It was based in Costa Rica, and they backed the digital dollars, by gold reserves. So there's all sorts, and that failed. Pretty much every digital gold has failed because it's still a separate commodity. Okay, so you can't have a decentralized network with a physical good. That's what makes the Bitcoin revolution so incredible, because it actually has a native currency. It's completely different. Another quote they had: at the root of the move toward a CBDC is the war on cash. The elimination of cash creates a potential for government to track and even control consumer spending. That is true. CBDC gives government more control over the supply and the use of money, but it is not a war on cash. A CBDC is a form of cash. Cash is the form of money that, extinguishes debt or doesn't create debt in the transaction. If I pay with a credit card, there is debt on the back end. I don't really necessarily have to. If I use a debit card, I don't necessarily have to worry about it. If I use a credit card, I have to pay it later, right? It creates a debt. Even a check, old day paper check, that creates a debt that is settled on the back end by the banks. Okay, so cash does not create debt in any way. It is instantly settled. And that's what a CBDC is. And so a CBDC is cash. Now, the thing is that this form of cash takes the power of supply and issuance and use even of this money away from banks. Today, banks control the supply of money through loans. The Federal Reserve doing QE is not money printing. The government borrowing money to spend it today, taking money out of savings to spend, is not money printing either. The only form of money printing that we really have today is banks making loans, credit creation through the private sector banks. So a CBDC takes that control of money supply and the use of money through banking regulation, takes that out of the control of the banks and puts it back under the control of the government. So that is what a CBDC is. And of course, SchiffGold doesn't know this. Again, they display great ignorance in all things money and all things digital currency. Okay. Next story is Russia becomes second most powerful BTC miner in the world. And this was a story out of Crypto Slate that I linked to. And here's a quote from the article. The U.S. remained in its position as the leading country with the most significant mining power, as it generates 3 to 4 gigawatts of mining capacity. After Russia, with 1 gigawatt, the Gulf countries follow as the third largest mining power in the world with around 700 megawatts of combined power. So very interesting. Russia is coming up quickly, and I have been reporting on a lot of this news out of Russia with state-sponsored like hedge funds raising money to invest in Bitcoin mining, state-sponsored Bitcoin mining operations, all of that, just over the last 6 months or so. So Russia is coming in to this game big time, and that alone gives it some sort of vote of confidence, some sort of air of great power competition, which is what people like Jason Lowery and his Soft War book, what that promotes is this Bitcoin as a proxy for great power competition. And yeah, so I think all of these kind of pieces are falling into place that this will become the meme. We'll see. First, Bitcoin has to defeat all the crazy climate people. So, all right, the next story is another protocol for pictures on Bitcoin stamps. And then I quote tweet this, there is a new protocol in town, Bitcoin stamps. There's a new way of storing images directly on Bitcoin, but they're very different from ordinals. Here's what the transactions look like. So what this does is it takes an image, you encode it in like base 64, and then you break up that encoding and you put it onto UTXOs. So you have to break up a Bitcoin transaction into many outputs, and on each output, you put as much data on there as you can. So this is highly bloating, very different than ordinals. Now, the problem to this is I saw a reply to this tweet thread from Trust Machines Co., I guess is the handle here on Twitter. But a reply to that said, oh, but these things can't be transacted. And that kind of makes sense because you would have to take all of those UTXOs, bundle them, and send them. I guess you could do it, but it would be extremely expensive. Think about you create one of these Bitcoin stamps and it has 1,000 UTXOs. Your transaction fee alone would be hundreds of dollars probably. And as Bitcoin fees go up in the future, it will just become more and more expensive. Now, this is permanent bloat on the Bitcoin network. And if these are one Satoshi outputs, that will be permanent bloat because it's not economically feasible to consolidate one Satoshi UTXOs. But anyways, and another thing is that if you do end up spending one of those UTXOs, it will break the stamp and then you can prune all the data necessary for that. So it's kind of an attack on Bitcoin. It's kind of not. It's kind of just a very inefficient use of possible block space. And I don't see these getting popular, where I do see ordinals getting somewhat popular, at least to become somewhat of a mainstay in the Bitcoin ecosystem. These ordinals and inscriptions will be, but I don't think Bitcoin stamps will be. I think this will be kind of something that's possible, but nobody ever does it. Maybe very few people. So anyways, that is an update on Bitcoin. And now to the macro side of the house, because this is Bitcoin and markets. The first Bitcoin macro-centered podcast starting back in 2016, continuing to today. And so we talk about all things macro and Bitcoin. But the de-dollarization derangement syndrome hits a new all-time high. And I just coined that term because it just is a crazy thing to think that the US dollar, which you can see on this pie chart here, and I think I posted that in Telegram this morning. Scrolling up, if my mouse will scroll properly. Just double checking. Yeah, I posted it in there. Okay. You can see on this pie chart, the US dollar is 60% of global reserves. The euro is about 20%. Japan is about 5%. The British pound is about 5% as well. But the US backs up the European Union. I mean, just look at this stuff with NATO going on and with Russia and Ukraine. The US is running the foreign policy of Europe. Well, I guess you would call them the Davos elite, but it's mainly Washington is the power in this relationship. The US dollar backs the euro because what are the foreign exchange reserves of the ECB? Mostly dollars. Same with Japan, same with Great Britain. So these are all dollar currencies. They're dollar derivatives, really. So this pie chart just understates it as well. That the strength of the US dollar is unassailable. It's unassailable. Now that you might think, oh, well, that's crazy coming from a Bitcoiner. How could you say that? Well, it's because of the form of the dollar as being credit-based money. It's based off debt, not based off a commodity, right? And the way we got to this point is that the world was starved for, not starved. What's the term I usually use? I can't think of it right now. It was not saturated by debt yet, and the debt was highly productive. You've heard of the things like leapfrogging technology. So Africa and even Southeast Asia didn't have to put in landlines. They could go straight to cellular technology, right? LTE, that kind of stuff. So this leapfrog effect made credit highly, highly productive in the initial uses of it. And so they liked it. And they used dollar debt because they could get money at 5% instead of, if they took it in their own currency, it would be 20% or something, So they used dollars, and plus a lot of these countries are exporting to the United States, and so they had a trade surplus with the United States. So they had dollars coming in to service this new debt. A lot of people think that, we need to export dollars, but we kind of do. We need to export, or it would be nice if we could export enough dollars to service the debt. But dollars can be printed anywhere. Hong Kong banks can print dollars. Singaporean banks can print dollars. Banks in Mumbai and Frankfurt and Johannesburg, they can all print dollars by making dollar-denominated loans. A lot of these countries, offer even government debt, dollar-denominated government debt. So the dollar is super, super dominant. It's not in any risk of going away. But the problem is, being credit-based money, it has diminishing marginal returns. So now it's not as productive to take out new debt. Plus, you have all this debt that you have to service. So the economy is slowly grinding down. There is a dollar shortage, or it feels like there's a dollar shortage, because you're not having as much growth to service the debt. So let's say you're growing at 10% and your debt service was about 5%, or your average interest rate that you paid on your debt was 5%. You could service that decently because you're growing. But now what if you're growing at 3% and your average debt load is 5%? Then, you're unable to keep up with your debt payments, and you feel like you have a shortage of dollars because you can't pay off your debts and you become insolvent. So it manifests as a dollar shortage, and that's a deflationary pressure. Okay. This will continue. There's no way out. The end is a deflationary grind, not an inflationary collapse. And so the only way out to return to growth and to save any sort of international trade, because when you have debt-based money, it's always someone else's debt, right? And in a world of deglobalization, where the U.S. is using the dollar system as a weapon, you want to go away from counterparty risk, go away from using money that's other people's debt, and going back to using commodity money that it contains the trust within itself. I don't have to trust the U.S. government that my gold coin is gold, or that my Bitcoin is Bitcoin. So the money encapsulates the trust in itself. And that's what we're going to go back to. Now, that doesn't mean the dollar has to collapse either. The dollar can be backed by Bitcoin. Easy peasy. So all those people that are saying, the dollar is going to collapse and stuff, there is no de-dollarization going on. If anything, I bet in 5 years' time, the dollar will just become more entrenched. The share that maybe the Chinese yuan has here, which is 2.8% on this pie chart, that might go up to 5%, but the US dollar is maybe going up to 65%. The euro is going to lose some to the dollar, etc. So the dollar is not in any danger of losing its world reserve currency status. It's in danger of losing its backing, which is the credit. So it needs new backing, is what I'm trying to say. Okay, let's move on here. Macron, he made a fool out of himself in China. So I linked to a couple articles about this. And I'll just read some of the quotes here. Macron, ad-libbing at times, spoke twice as long as his host, which was seen as a breach of protocol. Xi looked impatient, I have contact issues today, so it's hard to read the screen. Heaving several deep sighs, and the end of the press conference couldn't come early enough for him. And in another article, here's another quote directly from Macron. He said, quote, "The paradox would be that, overcome with panic, we believe we are just America's followers," Macron said in the interview. "The question Europeans need to answer, is it in our interest to accelerate a crisis on Taiwan? No. The wrong thing would be to think that we Europeans must become followers on this topic and take our cue from the US agenda and a Chinese overreaction," he said. So there is back and forth. How I kind of envision this, and I wrote about this a little bit on Telegram this morning, what is that, each of these countries has their elites. They kind of joined the team of the globalists in Brussels, and the globalists, the Davos Marxist folks. And that team has inertia. So you spent, say, 20, 30 years, maybe 50 years getting the right people in places of power, getting the right people educated at the right schools, um, getting the right ideology installed in these institutions of higher learning. So this type of institutional arrangement has inertia. Even if the elites are like, oh crap, we better pivot because this is not looking good for Europe. We're looking like we're facing a major, major recession, slowdown, depression, where the US is not facing the same thing, etc. And so even if the elites start pivoting, man, there is a lot of inertia there, and we'll see. But that's how I kind of view some of these things that Macron, some of the other politicians, Maloney and others, who knows? Maybe Maloney and Macron, or whoever takes over for Macron after this, they will form a Franco-Italian bloc in Western Europe. So anyways, very interesting to see what's going on. All right, let's move on to price analysis. So let me blow up this chart here. You can see we were very flat for the last 4 weeks, and this really added to a lull. People were lulled back to sleep. Bitcoin pumped really hard, and then it went sideways for like 4 weeks, 3 to 4 weeks. I think it was about 24 days. And that kind of lulled everybody back to sleep. And now this morning we are pumping again. So let me bring up this chart. I took that snapshot earlier today at about 23,300. It pumped about $1,000 since then, up to 29,100. And it's looking strong. It's breaking out of the top here. If it can close today above this line of 28,750, I think that should be considered a breakout, and we'll see where we head from there. Let me go to the daily here real quick. So yeah, I mean, this looks textbook triangle breakout to the upside. Of course, we had to be worried about a fake out. You can always have fake outs, especially in Bitcoin. But overall, like, the liquidity is very low. A lot of Bitcoin has been taken off exchanges. I wouldn't want to short this. Higher Bitcoin price fixes a lot of things in the industry. And so I think overall, the big money, they're mainly aligned with a higher Bitcoin price. As well as low liquidity, there's not going to be as much funny business going on the exchanges as well. So yeah, overall, this is all aligned to be another nice breakout, and we'll see where it goes from here. Okay, so that's price. I noted on here that there are several indicators I'm following that lead me to believe a breakout is imminent. And it's funny that I wrote that about 1 hour before the breakout. Support is building below the price around 25 to 26,000, and resistance at 29,000 is being chipped away. This week could be the start of a new higher leg. I'm detailing my views, charts, and evidence on the Market Pro newsletter tomorrow, so sign up for that and stay tuned. So Market Pro is my premium newsletter that I put out. It is a little bit up there in price, but you guys can get 50% off your first month if you go to bitcoinandmarkets.com/pro50. That is the best way to support my content. I appreciate everybody that supports the show. All right, let's get into the mining headlines. So I touched on the major headline, and that was the New York Times hit piece. But there were some other headlines. Arkansas, so they have a bicameral state legislature, so they have a Senate and a House. It's funny, I come from the only state in the United States that has a unicameral. So it has only a legislature. It's not a House or a Senate. It's just one, and the governor. But anyway, Arkansas is House and Senate, and they passed a bill protecting the right to mine Bitcoin. And I say that these good news pieces like this don't get a lot of headlines. This came out a few days ago, and I really haven't heard anybody talking about this at all. Of course, over Easter, I just was checking the headlines, checking Twitter stuff, and I didn't see anybody reporting on this. I actually had to go and dig out some news of the Bitcoin mining industry to find this passed in Arkansas. It does go to the governor's desk now to sign. And here's what it proposes. The bill proposes that that a Bitcoin mining business may operate in the state if it complies with state laws concerning business guidelines and tax policies, any ordinances concerning operations and safety, any rules or rates for utility service provided by or on behalf of a public entity, and state and federal employment laws. So pretty much, if you are a you follow all the appropriate regulations and laws and you pay your taxes, you can be a Bitcoin mining business. So that is very interesting the way they laid this out. I mean, it's super common sense. Why would it be any different than that, right? But this is just it's codifying your right to mine Bitcoin as if it's not some unsightly activity like cooking meth or something. This is a legitimate business. Okay, I'd like to see this in other states, and we'll see if that happens. I think Montana might have something similar, Wyoming. So this could continue to snowball and have more and more of these states signing on. All right. And it's big business. I saw Pierre Rochard talking in front of, I think it was the Texas committee or some Texas committee that was doing these recent bills there in Texas. And he was detailing out how much revenue it had brought into the local city, how many high-paying jobs, just XYZ. And so these states that do this and they attract this growing business, it can only be good for those states. So those states will benefit over the states that ban it, like New York. New York is losing people at a fast clip. Not quite 1 million a year, but it's getting close to 1 million a year. They're driving out new fintech companies, innovation of all sorts, Bitcoin, Bitcoin exchanges, Bitcoin mining. All that is getting pushed out of New York. It's just going to hurt their economy. And I even have heard that all the New York Wall Street banks, they're opening up second headquarters, whether they are opening up, whether they're opening up in South Dakota, because I know South Dakota is counterintuitively a big place for banking headquarters because they have the most friendly regulations when it comes to banking in the country in South Dakota. So some banks are moving there. Some banks are moving to Miami, opening up second headquarters and stuff. So this business is leaving New York State. It's leaving California. Tesla moving to Texas. There's talk, about the Suarez, the mayor of Miami. He was courting a lot of the Silicon Valley companies to come and make Miami a new Silicon Valley. So, there's all sorts of stuff moving, and Bitcoin mining is going to be right in there as one of the kind of bedrocks, I think, of this new ecosystem. So very interesting. All right, next thing up I have is about this isn't technically mining, but it kind of is. It's within the controversy of mining. So Ethereum's Shanghai update opens a rift in crypto. And I linked to a Wired article. And in this Wired article, they talk about Ethereum being able to unstake their coins in the proof of stake that's coming up with the Shanghai fork in 2 days from now. And this is seen as like cutting the final cord with mining. Anyways, so I put a couple charts in here, and we should expect when it is, when there's a hard fork, you always have a pre-pump hard fork, or pre-pump to the hard fork, and then you have a sell the news event. You can see that happen with the merge. I'll bring up, this is the dollar price. Very similar level as well that the pre-pump got to for Ethereum. So we'll see what happens after this Shanghai fork. And also here is the Bitcoin price of Ethereum. It has gone all the way from about, let's see, this is 0.08 roughly around the merge, and it's down to 0.065. So that's a 20% drop. And we'll see what happens with the Shanghai fork. A lot of people are talking about this could be a big time to dump your Ethereum. You unstake it and you dump it. There's a lot of risk with the SEC. And so these big stakers, they might have staked early, because I think you could stake like a year before the merge. And now they're going to unlock it and sell it before the SEC comes in. So there's a lot of problems there. But of course, they try to diss on proof of work versus proof of stake. And I include some background for beginners here. And I wanted to read a little bit out of the Bitcoin dictionary. So if you guys can see this is I'll stop sharing for a second. This is my Bitcoin dictionary. It came out back in 2020, has 180 terms, all having to do with Bitcoin stuff. And let's see if I can show this. I don't know if it'll come through, but each word has a definition and then like a Wikipedia kind of summary. And I'll read here what I have for proof of stake. So proof of stake, a distributed consensus mechanism whereby prospective block producers are required to put coins at risk to enforce their honest behavior, and where the next block producer is chosen algorithmically instead of competitively through mining. And then I have a discussion section. In proof of stake, instead of mining, block creation is randomly assigned through an algorithm to any participant putting coins at risk. Staking is usually done by holding coins in a specific way, immobilizing them for a period of time. If the node misbehaves, the staked coins will be confiscated by the network. The idea for proof of stake was first proposed in 2011 on a bitcointalk.org forum, and the first cryptocurrency to use it was Peercoin in 2013. Collecting, ordering, and building transactions into a block is not a computationally expensive process. Hence, proof of stake must simulate cost from within the system. That's a very important thing. With mining, there is explicit cost. It costs me to burn the energy, buy the equipment, house the equipment, run the equipment, plus the energy. All of that involved in the cost. So proof of stake is kind of just a simulation of these costs. It's an inferior, second best simulation of the natural incentives brought on by the costs of proof of work. That's very important to understand. So in its pure form, this process removes a dynamic market process for producing blocks present in mining through capital expenditure and electricity costs. Proof of stake claims some benefits over mining, like making 51% attacks more expensive, and proof of stake theoretically being less energy intensive. But it has several critical problems researchers continue to struggle with in 2020. The most well-known issue is the nothing at stake problem. This problem is characterized by the misaligned incentives which occur around chain splits, whether honest or malicious. In proof of work, block producers choose one chain to extend due to the physical cost constraints of mining. However, in proof of stake, block producers are incentivized to extend multiple blockchains in case they are participating on the wrong chain. Research in 2020 is pursuing punishment-based solutions to simulate these costs, which proof of work naturally accomplishes. The second well-known issue is the stake grinding attack. This attack is characterized by a block producer attempting to game the random assignment of the next block producer to benefit themselves. It is accomplished by creating many blocks and selecting the one which favors their stake. This effectively turns proof of stake into proof of work because it's limited by the speed and computational effort exerted to find the biased block. Proof of stake must programmatically defend against this attack, while this class of attack does not apply to mining. There are other criticisms which are not considered attacks, the largest being proof of stake lacks a distribution mechanism, where mining pressures block producers to sell their rewards to pay their costs. So in mining, you incur costs naturally. So you have to sell the Bitcoin that you earn, at least part of it, to pay your costs. So that naturally distributes the Bitcoin. But in proof of stake, it is relatively real cost free. So you don't have to sell the money that you get from staking. So there's no natural distribution mechanism. And also it tends to accumulate to the people that have more stake. So the rich get richer in proof of stake. Let me continue here. The block producers can continue to accumulate coins, increasing wealth inequality. These many issues have produced weak outcomes so far. So this is long before the merge happened that I wrote this, but maybe I'll have to do a second edition of the Bitcoin Dictionary and get that out. To address initial shortcomings, researchers are pushing towards more complex schemes involving punishment and voting, slashing, and that kind of stuff, likely opening their networks up to new types of failures and attacks. And we haven't seen that quite yet with Ethereum, but we'll see when they get to unlocking all of their coins. But yeah, that was a section from the Bitcoin Dictionary. You guys can go right to it on Amazon, bitcoindictionary.cc. We'll take you right there. That link still should be working. So that's another way to support the show. Okay, let's get back into this report. Lynn Alden, of course, I disagree with a lot of her stuff, but she's super smart and has great insights on a lot of things. And she goes, commodities don't need to wait for a group of paid developers to allow them to be unstaked. Securities do. So if you are holding this and now all of a sudden you can unstake, what does that statement tell you? Well, you better hurry and dump it before the feds make this illegal or the SEC comes in and makes this a security. I mean, that would crash the price of Ethereum. So anyway, here we go. Difficulty and hash rate. You can see that it has up slightly on the week, but nothing significant, not at all-time highs. It went up 2% and it's estimated to go down 1% in 10 days. Overall, it's a pretty steady, healthy period waiting for what's next. Okay, mempool here coming up, and these color codes here are the fee. I think pink is 1 Satoshi per byte, 2 Satoshis per byte, 3 Satoshis per byte, or, and so on. Maybe it's a little bit different. Maybe it's grouped by 10 Satoshis. So the pink are still the cheapest transactions. Then this would be the next cheapest, the next cheapest, the next cheapest. And you can see that we had this ordinal craze spike that also corresponded with people taking their money off of exchanges. And since, when is that? Kind of mid-March or so, that peaked and it's been coming down. The network is handling this. What do I write here in the report? I say, this signifies the network continuing to handle the traffic, but that traffic is picking up slightly into an upcoming price move. And again, I talk about this upcoming price move, which seems to be underway. All right, Lightning Network. Couple interesting topics here. And this is Coinbase will integrate Bitcoin Lightning Network, says CEO Brian Armstrong. So WS Bitcoin on Twitter said, it's weird how Brian Armstrong is actively ignoring the Bitcoin Lightning Network. He hasn't ever tweeted about it, not even once. And he makes a link to previous, a Twitter search. And Brian Armstrong says, my tweets auto-delete after some number of months, so there is no search history. Lightning is great and something we will integrate. We will integrate. So very interesting. It looks like, they're coming around. They are following their incentives. Coinbase is not as militant against the Lightning Network as others. They were one of the most, I guess, hardcore towards, not SegWit, but towards the 2x. What was that called? SegWit 2x? Now I can't even remember the damn term for that. The corporate run hard fork that tried to get 2 times the block size into Bitcoin that we had to do no 2x2, and we had this big campaign in Bitcoin going back in 2017. Coinbase was one of the big parties to this corporate hard fork of Bitcoin that was ultimately defeated. But I don't think that they were as militant. Sorry. I don't think they were as militant as others, like blockchain.info, blockchain.com now. That owner of blockchain.info, he said pretty much he will never support SegWit transactions. He'll never support Lightning Network. He'll never support any of that. And of course, they were a bigger player back then. Now they're kind of been marginalized to a high degree, especially because they haven't integrated SegWit. So we'll see. We'll see how this goes with Coinbase and when they'll integrate Lightning, but that's big Lightning news. Another one here is kind of a controversial article. It's from the Daily Hodl, which is a strong Bitcoiner website. So this is from a strong Bitcoiner perspective. And the headline is Bitcoin's Lightning Network adoption in jeopardy? Liquidity and risk issues loom large. Although, and this is what I pulled out from some quotes here, although Lightning Network's popularity and adoption are increasing, it features some risks users might be unaware of. First, Lightning channels are fundamentally anonymous and decentralized, meaning the responsibility is shared solely by the parties involved. Second, as all transactions are recorded off-chain except the last settlement, all funds may be lost if any participant closes the channel. Third, there's the risk of malicious cyber attacks that can disrupt transactions and increase network congestion. And fourth, there's a risk of a counterparty default. I don't really think so. Okay, now I think the only one that's really legitimate in here might be this malicious cyber attacks on Lightning nodes. So there's something in Bitcoin also like called an eclipse attack, where you become the only, like you run a bunch of malicious nodes that surround another node. Like let's say you're running Coinbase's Bitcoin node or Kraken's node, and you get an eclipse attack where you surround that node. All of its connections are coming through these malicious nodes, and then you can mess with them, right? You can steal coins or figure out their private keys or whatever. I don't know. But there's an eclipse attack. This might happen to Lightning nodes as well. There might be some other sorts of unique attacks that can be put on Lightning nodes. I'm not a big expert on all of these specifics, but that one I can see. So the first one about the responsibility shared between these parties involved, yeah, that's not really a downside to me. It is the one downside of that is that many people won't run their own node, and so it'll be custodial, right? So that is not necessarily good. It's not super bad either. I mean, would you rather people not hold any Bitcoin or use custodial Lightning? That's pretty much going to be the option in the future. Second, as all transactions are recorded off-chain except the last settlement, all funds may be lost if any participant closes the channel. That's not true at all. Okay, these are cryptographically signed, and you can only publish the last receipt, the last signature that went on there. You might, I think, be able to publish a previous one and try to take some coins back that you have already spent, but then there's a period, I believe. Again, I'm not a super Lightning expert on all the technicals, but I think there's a period where you can dispute that built into the protocol. But geez, don't quote me on that one. And then lastly, they say, and fourth, there's the risk of counterparty default. I mean, no, your channels can't be defaulted on because that Bitcoin is sequestered cryptographically. Now, if you're talking about an outside business, so Kraken goes under or Binance goes under and they had Lightning channels, they could go insolvent and they could default outside in the real world, not in the Lightning Network. And then that would cause liquidity problems within Lightning Network because they'd probably take Bitcoins out of their channels, to help their solvency in the real world. So there is that problem, but not in that you can't default on a Lightning channel. I don't think that's legitimate concern here. But interesting that this article came out in Daily Hodl because Daily Hodl is a strong Bitcoiner news outlet. So anyway, and that's it for the newsletter. So guys, make sure you go to bitcoinandmarkets.com and sign up for the free newsletter that comes out weekly. And also my premium stuff comes out at least once a week. I've been getting out, I think last week I had 2 out. I'm not sure. And I've gotten 3 out in the last 2 weeks, I think is what it is. But yeah, I appreciate you guys hanging out with me today. Hope you have a good rest of your week. You guys can join me here almost every day, live streaming on YouTube, Twitter, Twitch, and Telegram, and also Vita now. I'm live. I should be live streaming over there, and I think I had to check out that platform more because there's ways that you can take like super chats in a way, charge money to message in questions. So I'm going to be taking a look at that. But yeah, check out the Telegram, t.me/Bitcoin and Markets. That's where I hang out most of the day. And that's going to do it, guys. Thanks for joining me, and I'll see you on the next one. Bye.